Welcome to the deep dive. We're here to, cut through the usual noise and really get you informed. Today, we're diving into a brand that, well, most of us probably know pretty well, LuluLemon Athletica. It's basically synonymous with yoga pants, that whole healthy lifestyle vibe. And yeah, let's be honest, a bit of a premium price. But what happens when even a super strong brand like this takes a big hit? Their stock dropped like 17% after the last earnings call. Pretty surprising. So we dug into a really detailed financial research report on LuluLemon. And our mission today really is for you, the curious learner. We're going to unpack those latest earnings numbers, break down their business model, which is actually quite clever, look at the risks, but also some surprising strengths. And then just for fun, we'll run LuluLemon through a kind of Buffett-style checklist, the goal, to figure out if this giant, after that price drop, might actually be one of those rare finds. A great company, but now at a fair price. We want to give you the insights, not just what happened, but why it matters for LuluLemon going forward. Okay, so those recent numbers, let's unpack them. The Q2 report for fiscal 25, it was a bit of a mixed bag, wasn't it?
Yeah, it definitely was. So net revenue, it grew about 7% year over year, hitting $2.53 billion. But that was actually just a tiny bit below what analysts expected, like just under the $2.54 billion estimate.
Right, just missed on sales.
Yeah.
But the earnings.
That's where it gets interesting. Earnings per share, or EPS, really popped. It came in at $3.10, beating the forecasts by a solid 8%. So yeah, profits looked good.
Okay, so profits beat, sales slightly missed, but the stock tanked, like 17%.
Exactly. And that's the really fascinating part here. It makes you ask why such a massive reaction. It tells you a lot about, market psychology right now. It seems the market just zeroed in on that tiny sales miss and, probably even more, on what management said next, their cautious outlook, especially for the U.S.
Yeah, the U.S. market seems to be the sticking point.
It really does. Even a small crack in the growth story for a company like LuluLemon, which trades on high expectations, can cause a pretty dramatic repricing.
And management didn't really try to hide those U.S. issues, did they? I saw CEO Calvin McDonald talked about needing to do better for their guests, focusing on product and experience.
That's right. He said, we know we can do better. That's the focus. So taking ownership, which is good. And the CFO, Megan Frank, also mentioned they're working on ways to handle higher tariffs. Those can definitely squeeze profits.
So they're adjusting. How does that play into their forecast for the whole year?
Well, if you look at their updated full-year guidance for FY 2025, you can see a bit of a strategic shift. They're now aiming for revenue between $10.85 and $11.0 billion, and EPS between $12.77 and $12.97.
Yeah.
But the really key detail, that guidance now includes an expectation of a 1-2% decline in U.S. sales.
A decline, wow.
Yeah. But they're banking on strong growth still coming from China and other international markets to make up for it. So it's not just a temporary thing. It feels like a real recalibration. They're looking overseas for that future engine.
Okay, so the U.S. is slowing, internationally growing. But what's the core engine itself? How does LuluLemon actually make its money day to day? It's premium apparel, sure, but it's built on this, omni-channel thing, right?
Absolutely. It's not just one thing. Think of it as hitting the market from multiple angles. Their main money comes from two big streams. First, the actual physical stores they operate. That was about 45.8% of revenue last year. Then there's the direct-to-consumer, basically their website, which is huge for them, around 40.6%.
Okay, so stores and online are the big two. What's the rest?
The rest, about 13.6%, falls into other. That includes things like selling wholesale to some partners, their outlet stores, and remember, LuluLemon Studio, that's in there too. And product-wise, yeah, women's apparel is still the foundation, but they've made real inroads with their men's line. Plus accessories, yoga mats, bags, and even have footwear now. It's broader than many people think.
And there's that whole lifestyle aspect. People say they sell more than just clothes. How does that actually work in the business?
That's spot on. It's crucial. Beyond just the nice fabrics, they really lean into community and services. Think about the free yoga classes they often have in stores or running clubs. Those aren't just, nice little extras. They drive engagement. They build loyalty.
So create stickiness.
Exactly. They call their customers guests, and they've built this incredibly loyal base. Their membership programs apparently hit something like 9 million members by mid-2024. These are generally affluent people focused on fitness who buy into the whole LuluLemon idea. Makes them less likely to switch brands.
Interesting. You mentioned LuluLemon Studio in that other category. That was the mirror acquisition from 2020, right? The interactive fitness mirror. How's that going?
Yes, Mirror. That was a big, ambitious bet on home fitness tech.
Yeah.
But it really struggled to gain traction, never really scaled up much beyond, I think the figure was tens of thousands of subscribers back then. It ended up costing them quite a bit. They took a $443 million charge related to it back in 2022. Yeah, so it really highlights that while they do try new things, their bread and butter, the vast majority of their money, still comes from selling merchandise, clothes, accessories. It was kind of a lesson, maybe, in sticking to your knitting, or at least being careful with diversification.
Okay, so we've got the immediate issues in the U.S. market. But looking longer term, what are the bigger, maybe more fundamental challenges LuluLemon might face? The structural stuff.
Right. This is super important for thinking about their future. First off, there's the question of market saturation. How many more yoga pants can they sell in North America, realistically? Future growth probably has to come from really pushing into new categories like they're trying with footwear, or more likely making a big success of their international expansion.
Which comes with its own risks.
Totally. They have this big goal, the power of 3x2. Aiming to double revenue again by 2026. That relies heavily on executing well overseas, especially in China, right? It's already out 12% of their revenue and grew like crazy, over 30% in 2024. But relying on any single international market, especially China, brings geopolitical risks, regulatory risks. Things can change fast.
And what about competition? The athleisure space is crowded.
Oh, incredibly crowded. It's not just the giants like Nike breezing down their neck. You've got trendy, upmarket brands like Alo Yoga or Vori chipping away at that premium image. And then you've got value players putting pressure on prices from below. Plus, you always have product risks. Remember the sheer pants fiasco back in 2013?
I remember that.
Or risks related to their manufacturing, which is mostly outsourced to Asia. Any disruption there could be a problem. These are the long-term things management constantly juggles.
Okay, so with all that going on, competition, expansion risks, U.S. slowdown, how does it impact their actual bottom line?
Yeah.
Let's talk costs. Where does LuluLemon's money actually go?
Good question. If you break down their expenses, there are really two main categories: cost of goods sold, or COGS, and then SG&A, which is selling, general, and administrative costs.
COGS being what it costs to make the stuff.
Exactly. Mostly the variable cost materials, the technical fabrics like Luon and Nulu they're famous for, the labor to make the garments. In 2024, that was about 40.8% of their revenue. So, think of a $100 pair of leggings, maybe around $41 of that is the actual cost of producing.
Okay, about 41%. What about SG&A?
SG&A covers everything else needed to run the business. Payroll for store staff, corporate teams, rent for their, 600 plus stores worldwide. That's a big fixed cost with all those leases. And marketing, too.
Yeah.
In 2024, SG&A was about 35.5% of revenue. But what's really interesting with LuluLemon is their marketing spend.
How so?
Historically, they haven't spent a ton on traditional advertising compared to rivals. They built the brand more through grassroots stuff, community events, word of mouth. So marketing isn't actually this massive drain on their profits like it is for some other big retailers.
That is pretty impressive cost discipline. Building a brand like that without massive ad budgets.
Yeah.
But with global expansion, rising costs, tariffs, can they keep that up? Are margins likely to get squeezed?
It's definitely something to watch. But historically, their discipline has been excellent. The gross margin, the profit just from selling the goods, actually bounced back to near record highs, around 59–60% by FY 2024. That shows they still have pricing power and manage their sourcing well. And maybe even more importantly, they've shown fantastic operating leverage. Meaning, as their sales grew massively, like 5 times bigger, their overhead costs, the SG&A stuff, didn't grow nearly as fast. Their SG&A ratio actually improved, dropping from around 40% down to 35%. That shows they get more efficient and profitable as they scale up. So while, external things like tariffs or wage inflation are always potential pressures, their track record suggests they manage costs pretty tightly internally.
Okay, so strong margins historically, careful cost control. Let's talk about leadership. Who's actually making the decisions here? Who's steering the ship through these slightly choppy waters? And how different is it from the early days?
Right now, the key figures are CEO Calvin McDonald, who joined in 2018, and CFO Megan Frank, who took over in 2020. It's definitely a different era compared to the time of the founder, Dennis Chip Wilson. He had a huge impact, obviously, but also brought some controversy. He stepped down from the board quite a while ago now. This current team feels much more like, Professional management. They have a solid track record of setting targets and actually hitting them, like that goal they had to double revenue by 2023, which they pretty much did by 2024, hitting $10.6 billion. And they seem pretty transparent, too, like how they openly addressed the mirror situation when it wasn't working. That kind of stuff builds investor confidence.
And how aligned are they with the people who actually own the stock, the investors?
Well, one really interesting aspect is the insider ownership. It's quite high, around 26%. And Chip Wilson himself, the founder, is still the biggest individual shareholder, holding about 15%.
So insiders have a lot of skin in the game.
A lot. And maybe even more telling, CEO Calvin McDonald actually bought a significant amount of stock himself recently, around $4.8 million worth back in June 2025 when the price dipped.
Wow, that's a strong signal.
It really is. It suggests he believes the stock is undervalued and has confidence in the future. Beyond insiders, the ownership is heavily institutional. Big firms like Vanguard, Fidelity, BlackRock, Advent International own about 84% of the shares. And generally, they seem supportive of management. You can see that in how they vote at the annual meetings.
Now, LuluLemon doesn't pay a dividend, which might surprise some investors looking for that regular income. So if they're making good profits but not paying dividends, how do they give value back to shareholders?
Their main strategy for returning capital is through share buybacks. Pretty aggressive ones, actually. Just in June 2024, they authorized another $1 billion for repurchases. That's a big commitment, signaling confidence and their plan to return excess cash. And they've been doing this consistently. Over the last 10 years or so, they've actually reduced the total number of shares outstanding by about 15%, went from roughly 140 million shares in 2015 down to around 121 million by 2025.
And fewer shares means each remaining share represents a bigger piece of the pie, boosting EPS.
Exactly. It makes each share inherently more valuable. For a company still focused on growth like LuluLemon, management clearly sees buybacks as a more flexible and effective way to enhance shareholder value than locking themselves into a fixed dividend payment.
Okay, this is fascinating. Let's shift gears a bit and put LuluLemon through maybe the ultimate investing filter, Warren Buffett's checklist. How does this company stack up against the kind of things the Oracle of Omaha looks for?
Yeah. The Buffett test, it's always revealing. And honestly, on the quality metrics, LuluLemon scores really, really well. Almost ticks all the boxes for a great business. You're looking at incredibly high gross margins, right? Consistently up in the high 50% range. That shows pricing power.
Check.
Excellent returns on equity, averaging over 30%, hit 42% in FY 2024. That's phenomenal efficiency in using shareholder money.
Check.
Superb return on invested capital, around 45%. Again, shows they invest money really well. Consistent, strong, free cash flow, usually way over 10% of revenue. They generate a lot of cash.
Check.
The balance sheet is very conservative. Very little debt relative to equity, well under Buffett's typical 0.5 benchmark. Minimal interest costs, healthy current ratio too, about 2.3x, and depreciation is low compared to profit. These are all signs of a financially solid, high-quality operation.
Okay, so lots of checks on the quality side. Where did it maybe not quite fit the Buffett mold, at least historically?
Well, the main sticking point historically has almost always been valuation. The price. LuluLemon stock for years was just too expensive for a classic value investor like Buffett. Its price-to-earnings ratio, the PE, often sat between 30 and 50, sometimes even higher.
Which is way above Buffett's usual comfort zone of like under 15.
Exactly. He wants that margin of safety. Paying 50 times earnings doesn't leave much room for error. Same with price-to-book value, it was often in the teens, whereas Buffett prefers something closer to 1.5.
Oh.
Also, while earnings growth was strong overall, there were a couple of years with slight dips in EPS, like FY17, FY18, FY22. Not quite the perfect, uninterrupted 10-year rise he loves to see. And a couple of other minor things on book value consistency or owner's earnings yield.
So it sounds like the conclusion for years was fantastic business, amazing quality, but just too expensive based on traditional value metrics like Buffett's.
Pretty much, yeah. A classic growth stock trading at growth multiples.
And this is the key point connecting back to the start. Something significant changed with that recent stock drop, right?
Precisely. This is the aha moment, maybe. That market correction, that 17% tumble and the subsequent weakness, has dramatically changed the valuation picture. Suddenly, at the current price, around, say, $170 a share, LuluLemon does look much more interesting, even through that strict Buffett value lens.
How so?
Well, its PE ratio now is hovering somewhere around 11 or 12. That's actually well under Buffett's 15x benchmark. Suddenly, it's not expensive anymore by that measure. And our analysis suggests that At this price level, there's now a plausible, albeit modest, margin of safety. It's potentially offering that rare combination, high quality at a reasonable, maybe even cheap price. That just wasn't the case for most of the last decade.
That really does shift the perspective. So if the valuation looks more attractive now, what does a more detailed valuation method, like a discounted cash flow analysis, tell us? What might the intrinsic value actually be?
Okay, so a DCF basically tries to estimate the present value of all the future cash a company is likely to generate. We started with their free cash flow from FY 2024, which was strong at $1.58 billion. Then we ran a few scenarios based on different future growth assumptions for that cash flow. In a pretty conservative case, assuming only 5% annual growth in free cash flow going forward, our model suggests an intrinsic value of around $210 per share.
$210. And the stock is around $170 now.
Right. So even in that conservative view, the current price is below the estimated value. If you wanted a 25% margin of safety on that $210, you'd be looking for a buy price around $158.
Okay, what about less conservative scenarios?
Well, our nominal or base case used a 15% free cash flow growth rate, which is closer to what analysts might expect given their international plans. That puts the intrinsic value at approximately $326 per share.
Wow, significantly higher.
Yeah. And then, just to push it, an optimistic case with 25% growth, maybe if everything goes right internationally and the U.S. rebounds, that suggests a value up around $483 per share.
So the key takeaway from the DCF seems pretty clear then.
I think so. The really striking thing is that the current market price, around $170, is below even the most conservative DCF estimate we ran. Unless you believe LuluLemon's growth is going to fall off a cliff entirely, this strongly suggests the stock could be fundamentally undervalued right now. It highlights just how strong their underlying cash generation, their economic moat really is, and maybe the market is overly focused on the short-term U.S. headwinds.
Okay, so let's recap. We've really dug into LuluLemon today, a brand facing some undeniable short-term challenges in the U.S. market, which led to that big stock drop. Yet beneath that, we see still strong international growth potential, a really well-managed cost structure, impressive profitability metrics, and a leadership team that seems very aligned with shareholders, even buying stock themselves.
And the big picture shift is just fascinating. For years, this was the definition of a high-growth, high-multiple stock great company, but expensive. Now that correction has potentially flipped the script. It might actually be offering that rare chance to buy quality at a reasonable, maybe even attractive price, a situation that just didn't exist for LuluLemon for most of the last 10 years.
So it leaves us with a really provocative thought for you, the listener, to mull over. Given LuluLemon's powerful brand loyalty, those ambitious global plans, and now this potentially attractive valuation, the question is, can they successfully navigate these current U.S. market bumps and get that growth story firing on all cylinders again? Will the underlying quality of the business ultimately win out over these temporary headwinds and deliver on its long-term promise? And maybe just as interesting, what does the market's dramatic overreaction to a slight miss tell us about investor sentiment and the premium placed on flawless growth in today's world? Something to think about. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to learn more about this topic, subscribe us on Apple, Spotify podcast channel. Deep Value Investing. Don't forget to take the book list of value investing from the episode description.